What's up, everybody? I'm back again. Da'zjon Tinae, the owner of Tanae's Wealth Management. I'm here today to discuss how to pay less taxes and some of the strategies that a lot of wealthy people do as far as reducing their taxable income so that they can pay less money over time. So, before we tap in everything, you know how I like to start everything off. Check out The Essentials of Good Credit. This is available on Amazon, written by myself. The Principles of Stock Market Investing. I wrote that as well. I think this would be a really great book for a lot of people. And then lastly, Life Finance is an Opportunity. This is a really great book. I really advise a lot of people to check this out on Amazon. I've left the descriptions of the books in the box below, so make sure you guys check that out. So today, I really want to discuss a lot of things that I've wrote down today that I found in research and things that I've done myself on how to reduce your taxable income. So one of the first things that I want to talk about is one thing you can do is increase your 401k contributions. So a lot of people get mad and upset at wealthy people because they're going by and basically paying $0 as far as federal taxes, and people are freaking out saying, well, these people need to pay money. And it's like, why would you want to pay money on your taxes? Why would you want to pay taxes? I don't want to pay federal taxes. I don't want to pay state taxes. And besides that, you pay taxes and you don't get anything fixed. Railroads still trash. Police officers still not doing anything right. I mean, it's a number of things that I encourage people to learn about, not just the law, but literacy in general, because it's a lot of things that you can do. So back to the 401k contribution. Increase your 401k contribution at work. There's a lot of people that have 401k and they don't take advantage of it. There's a lot of people that do have 401k and sometimes they don't contribute enough. What I'm saying is, and to give you a measurable argument, let's just say somebody makes $165,000 a year. If you're single, that puts you in the 32% bracket. So assume you increase your contributions over a period of time. And now let's say for the year after your contributions, you're down to $159,000 for the year. Once you get into $159,000 a year, that drops you into the tax bracket below where you currently are. So you'll go from 32% at 165K down to 159,000, which drops you to the 24% bracket if you're single. Now that is the range of $85,526 to $163,300. So you can see there where increasing your contributions at work can drop you down to that next taxable bracket below, which would then save you some money. So make sure you're actually looking at how much money you make over a period of time and actually mapping out a plan to keep that as low as possible. Because if you don't pay attention to your 401k contributions or what you're making as far as income, you'll end up in that higher bracket every single time. And I encourage people, if you can, sometimes go above the employer match. So if they're saying, hey, we'll match you at 6%, look, try to get 7 or 8 or 9. Get as much as you can, of course, within the means of living that you want to do. So don't overdo it either, but do it at a point to where it's just enough to get you over that hump. This takes me into the next step, and I think a lot of business owners are going to like this idea. So some people say, well, I don't like Donald Trump and Jeff Bezos because they don't pay taxes. Look, I'm not here to advocate for being rich. I'm not here, and I'm not broke either, for people that are watching the video that want to say, well, you don't make money, so why are you defending them? Look, I'm going to give you some very simple ideas that can really give you an idea of how this really works. Start a business. I'm sitting in a recliner right now. Got a TV behind me, cameras right there, another couch right there. Those are all tax write-offs as far as business goes. So I purchased those things. I could write those off because this space that I'm in right now is considered my home office. So I'll talk about home office later because that's also a tax deductible way to where you can decrease your taxable income. But let's just keep it straight business based first. Furniture, you can write that off. If I take my clients out to eat, just regular meals, maybe, a small sit down at Applebee's, that's tax deductible. Equipment that you buy. So my iMac that I'm looking at, my phone that I'm using, things like that are all tax deductible as well as far as getting write-offs. A lot of people really don't take advantage of these things, and they feel like people are overusing the system when in reality you're getting benefits for basically increasing economic activity. That's how people should look at it. So advertising, marketing, your internet service, your office space, all of those are tax deductible. Hire a CPA. I will say that because a lot of people may not think that hiring a CPA is effective, but they are paid to find these things. The next thing I want to say about business owners that is really beneficial, look at barbers that have their kids sweeping the floor, or you go to a Chinese restaurant and you see kids working at the register. You know what they're doing? They're taking advantage of the $12,000 that the government basically gives you tax free until you get over that threshold. So if I hire my son to work at my barbershop, he can make up to $12,000 tax free if he's under the age of 18. That's very beneficial because let's say I have multiple kids. Why would I want to take that financial impact as far as um, extra money that I'll pay as far as taxes when I can pass that money on to my kids? And guess what? They're getting tax free money. I would never want to put myself in a position where the government can reach more in my pockets because what's the benefit? Oh, I'm paying taxes. Hallelujah. Congratulations. Like I don't understand the concept that people try to make about those who don't pay taxes legally. I mean, there's a number of things that you can do. Or, for example, when people get mad at Donald Trump, oh, you don't pay any taxes. Look, I haven't seen his tax transcript, but what I do know, Trump University was a flop. I know Trump Airlines was a flop. All these businesses that he started that people used to make jokes on, they all flopped. Those are also tax deductible. People forget that in the grand scheme of things. But this takes me into my next topic. You also have people that are working for employers. Do you have an HSA, a health savings account? If you do, you should contribute more to your health savings plan. And the reason I say that is because not only are your contributions tax deductible, but they grow tax deferred and you can withdraw them for medical expenses. So that can knock down your taxable income. Think about the example I used earlier about the 165,000. Um, Imagine if you're using a combination of your HSA, business write-offs, or sometimes even contributions to your 401k. You can knock down that tax bill more than you think. That's why I tell people go above what you can do because it saves you a lot of time and energy in the long run. So if you have an HSA, take advantage of that. You shouldn't. I would never leave an HSA on the table because it benefits you in so many ways. The next thing, make charitable donations. So charities, people say, oh, well, that person donated because they knew they were going to get a tax write-off. Bro, who cares? You're doing something for society and you're going to get a benefit for it. Stop trying to make it bad because people want to knock down their tax bill. I do it all the freaking time. So when I hear people say, oh, well, that person probably didn't have a good heart. They just wanted a write off. Okay, how much community service did you do? Oh, none for the year? Okay, stop trying to tell people what they should be doing and not should be doing or whatever. So let's go on to the next thing. If you have stock, let's take it back to investments again. If you have stock, you can donate stock where you have capital gain to basically offset what that tax bill could possibly be. So let me take us back to stocks trading and giving you an example of how to really look at the wash sale rule and how to really go about donating, for example. So let me go back and talk about the wash sale rule because I do this a lot when I trade stock. Say, for example, I've made two trades. I made $10,000 and then on one trade, I lost $2,000. Let's say these two trades were made in 2019 before the end of the year. If I go into the end of the year, I'll be paying not only taxes on that 10,000, but that 2,000 could also offset that. So I would have a capital gain of $8,000 where I would pay taxes on that $8,000. However, what I want people to understand about the wash sale rule is that sometimes you cannot buy, that security within a given period of time because you give up that opportunity to take advantage of the wash sale rule. So let's say, for example, I make a trade before 2020. So it's 2019. I make a trade for 10,000. And then the next year, like let's just say the 1st of January. Well, not the 1st of January because that's a holiday. Let's just say the 5th of January It's a Monday. It's a more open market day, and I lost $2,000. Guess what? I'm still paying taxes on that 10,000 because that $10,000 came the year before. So they're going to make me pay taxes on that 10,000 and not that 2,000. So you want to make sure you're reducing your taxable income by doing these wash shell rules within the same given year. So if I buy Microsoft and make 10,000 and then I lose 2,000 on Google, I'm gonna take that $2,000 loss before the end of the year so I can get that $8,000 capital gain rather than that 10,000. Because if that tax, let's just say that puts me into a new bracket, I'm definitely screwed because now I'm going to pay higher taxes in that case too. So we as investors, we like the wash shell rule because I take capital losses at the end of the year. I'm not going in with the super high number that I know could potentially put me up higher because I'm going to take that loss on purpose and knock it down so that I don't have to worry about paying that money in taxes, because you're going to pay more in taxes versus what that gain would potentially be. So you have to sit back and map out a real financial strategy to really understand what's going on. That's why I say if you make $165,000, you already know you're in the 32% bracket if you're single. So what that leads me to believe is that I'm trying to get as close to 163,000 as possible because that puts me in the 24%. I'm not trying to be up there in the 30s. And anybody that says, oh, well, the person is bad, evil, or whatever because they should have paid federal taxes, look, you're freaking crazy. Nobody should pay taxes. Stop telling people that stuff. That stuff is stupid. I ain't paid taxes in 2 years. So am I evil? Am I bad? Do I have bad intention? No, I'm just a business owner, 2 degrees, have licensing. I'm a business analyst, former mortgage servicer. I have experience, knowledge, education. People don't like to talk about that. They just like to say somebody bad because they knew something. You could do the same shit. Excuse me for cursing. I had to say it because I didn't really feel like doing all that. But real shit, though, you could do the same exact shit. I hate when people go on the internet telling people you can't do something or you got bad intentions because you making money. Like that. It makes no sense when people say that. Let's talk about medical expenses. If you make medical expenses, did you know you can deduct qualified medical expenses that are more than 7.5% of your adjusted gross income? So, for example, if you make $40,000, like the average man in America, black man at least, makes $40,000. After $3,000, did you know 7.5% of that is deductible? They don't talk about that. They don't talk about people that complain about, man, I got so many high bills. Most people don't even know that once they get over a certain amount, they can deduct the amount that they've been paying. That's 7.5%. They never tell you that. They just tell you, oh, you just got a lot of medical bills to pay. No, a lot of that is deductible. Don't let people tell you that. And I'm looking at it right here in the fine print. More than 7.5% of adjusted gross income. $40,000, which is anything over $3,000 in bills, 7.5% is deductible. There you go. Home office, where I'm sitting at right now. Now we're back on the home office example. Home office. This is considered my home office space as far as what I can claim on my taxes. Home office space is tax deductible as well. However, you have to have a profitable business in order to say, I have a home office. So if you have a home office, that is also tax deductible. You can write that off as well. Don't let people tell you that paying freaking taxes makes you a good person or equates to good personality, whatever it may be. Jeff Bezos and Donald Trump, you can say whatever you want about them. I'm not here to say I support them. I'm not here to say that I voted for them because I actually didn't. I'm just here to say they do the same thing. And I learned exactly from them, and I did the same thing, and I paid $0 in taxes. Last year when I filed, I had made $72,000. I paid $0 in taxes. I actually got back $1,500 in Fed taxes. I live in Florida. I don't pay state taxes, so there you go. It's just really making sure you understand everything that's being put out there for you. Even for people that pay student loans. If you're paying student loans, the interest payments that you're making on those student loan payments are tax deductible. They don't tell you that. If you have a home, it's the same concept. So you can get back so much money just hiring a smart CPA. That's all it really takes. Even if you don't have a business, there's a lot of things that you can do out here to reduce your taxable income. Buying municipal bonds. What are municipal bonds? You're loaning the government money, basically, the government, the state government at least, or your local, your little local government, whatever you got in your hometown. You're basically loaning them money, and the interest payments that they're paying you are basically Fed tax deductible. Well, Fed tax free. So you don't have to worry about paying all of that extra money on that. And not only that, it's knocking down your taxable income. So you're making money on something that's not really harming you in the long run because, again, you get those tax benefits, like I said. Now, one thing I see on social media has been real big. A lot of people have been talking about trading cryptocurrency, stocks, Forex, all of this investing type of stuff that everybody's so big in. I think it's becoming not really a wave, but I think it's really just a hype train, even though I think it could be for good reasons, but you really have to sit down and map out how you're investing. So these are some numbers that I put together that I really wanted people to understand. If you're a long-term investor, which is basically investing a year and a day, that means you're considered long-term versus a short-term person, which is doing less than a year. Let me read this question. It says, did you move to Florida due to no state taxes? And does that benefit you in any way besides the fact that you ain't paying it back? Definitely. That's one of the biggest reasons I moved to Florida, because I didn't want to pay state taxes and I wanted to get out of, like, for example, if I make $15 an hour in Florida, that's $1,000 every 2 weeks. If I lived in Georgia, where I'm from, I know I would have been making way less than $1,000 every 2 weeks. So I did that to avoid state taxes because, one, they're not really doing anything. It's not like, I don't think local governments or anything really invest in things that I like doing. So to me, it's like I'm going places like Texas or whatever that don't have state taxes because I'm not trying to pay any of that. So yeah, it definitely benefits you because one thing with me, let's just say I make $15 an hour. If I lived in Georgia, that's like maybe $200 I'm missing out on, maybe 150 to 200. If I got that money living in Florida, I could just defer that to my 401k or buy bonds or do something like that versus living in a state where it's just going against me because I can't do nothing with it if the state taking it. If I live in Florida and I'm getting that money, I can defer that anywhere I want to, whether it's a 401k, I can put it in an IRA, I could go get some bonds with it. See, I got wiggle room now. So with the wiggle room, I can avoid those taxes. I couldn't do that if I was in Georgia because they would have took that shit before I even got it. You see what I'm saying? So you really gotta map out a financial strategy because they're looking to take the money early. So you have to find ways to where you can defer that somewhere else so they can't touch it. So I always tell people, max out your IRAs. If you have a personal IRA or if you have a 401k with your employer, max it out beyond the employer match if you can afford to do it. Because if you can afford to do it, you're knocking down that taxable income. And like the example I said earlier, if you make $165,000 a year, that's the 32% bracket if you're single. If you can defer enough money to get you down to 163,300, that puts you in the 24% bracket. That's what, an 8% drop? That's pretty big. And 8%, that 8%, that's a pretty big number as far as income. So that is going to be a large drop versus you going from 165 to 163,300. You see what I'm saying? That's like what, a little over $2,000 drop versus an 8% drop where you would have went over that. So you really got to map out how you want to invest for the long term, because if you're doing it on the short term aspect, which takes me into the next point I was about to get into, you're going to be into the higher taxable side. So again, long term, you only have 0, 15, and 20% if you're investing long term. If you're looking at it short term, you have 10, 12, 22, and 24% brackets that you have to focus on. So if you make $45,000 a year and you're up on Facebook trading GameStop and all these other meme stocks that are giving you crazy returns, as soon as you sell it, you're automatically in that high bracket. So if you make $45,000 a year, and let's say you made $10,000 on GameStop and you sold it in like 2 days, that automatically puts you in the 22% bracket. Keep in mind, you only made $45,000 a year. You already in the 22% bracket. If it were long term, you can't go any higher than 20. So that means if you made $10,000, you just paid $2,200 in taxes if you wait until December 31st for that year. So what I'm saying is, if you made 10,000, you basically paid 2,200 versus me, a long-term investor who would have just went a year and a day, and I would have paid 1,500, making that same 10,000. So you just had a higher tax bill, really, because you wanted the short-term trade. That's why I usually don't recommend people to trade, because they're doing it trade by trade base. You can make 10K, 15K, lose 2K here, make 5K. If you make about 45K, you're going to be in that 22% every single time. And that's already 2% higher than the highest bracket that you can hit long-term investment. So when you think about it, a lot of people, sometimes they put themselves in those higher taxable brackets. Sometimes it's not even, the government trying to finesse more money out of them or whatever. Sometimes people don't sit down and map out a plan on how they want to get down their taxable income. And like I said again, I made $72,000 last year. I paid zero in taxes. I'm definitely going to make more money this year because, one, I got a new job. It's way more than I made at the last job. And then when that contract ends in 2022, I already know at the end of 2022, my tax bill is going to be crazy. I already know, because I'm going to be touching on six figures. So I know the first thing I'm doing, taking advantage of the wash sale rule, just to recap, because I have to take capital losses on purpose to keep that taxable income down. Increasing your 401k contributions as high as you can, of course, as far as what you can afford. So again, that 165 to that 163.3, that's a big difference. So think of that example as looking for a way to save 8% on your taxes. Start a business. I don't care if people tell you don't do something. Look, if you're starting a business and you have a sole proprietorship, LLC, corporation, or whatever, make sure you're taking advantage of your tax benefits. I could literally flip my phone around and show you my recliner I'm sitting on, the TV in the back, the furniture, the computer over there. I got a lot of computers, by the way. iMacs, I'm telling you, I buy that stuff with my business account. I have a business debit card too that I use. I use all of that to track my expenses. I shop on Amazon, so it's easily traceable, because the IRS will ask you to audit. They've audited me before. So when people say, how do you know this works? I just got audited. I passed. Nothing happens to me. I'm good. PPP free, all that. So I don't have anything to worry about, because, one, I do my own taxes. So that's not me saying try to figure this all out on your own. Research what I said too. Don't just go out and just start trying this stuff. Research what I say for validity, because, well, I'm not going to say I'm not right. I know I'm right, but no, go fact check me, and then call your CPA and have them help you out with these type of things, because you're leaving a lot of money on the table, not taking advantage of these opportunities, especially a lot of business owners that I know that are on social media saying, I paid this much in taxes, but in my mind, I'm telling myself, you got a business. How are you paying money like that? But it just takes me back to think maybe they're not taking advantage of, tax write-offs or any deductibles, tax credits, whatever it may be out there that can help you. A lot of people are just out here winging businesses, leaving opportunity and free money on the table. So again, you see those barbers, you go to Chinese restaurants, you see those kids out there working. They're taking advantage of that $12,000 tax-free money. A lot of those business owners are smart, especially those that have multiple kids, because not only are they giving them work experience, but you can hire somebody under the age of 18, literally under the age of 18. And that's a big benefit, especially $12,000. So maybe not so much for huge corporations or something like that. But if you're a small business owner like myself, someone that usually works independently with most of the work, I do have employees, but most of the main business functions that I do myself. So it helps out a lot. So when I have kids one day, they're going to definitely be doing some of these things, because now they can get that tax-free money and it's easy. So it works out. So again, when people tell you Don't listen to people that donate to charity. Donate to charity. Donate stock to donor advised funds if possible. If you don't know, ask a financial advisor. They'll explain a lot of that to you. Keep a file and a record of all of your medical expenses. Have a home-based office if you can or can't afford to. You know, pay attention to what you're putting into your house. So if you're a homeowner, you know, if you're paying mortgage insurance, you know, pay attention, document all of these things because there's a lot of benefits that come associated with these things. I know a lot of people tell me sometimes that they feel like certain employers are wrong because they're exploiting workers, when in reality, you would do the same thing if you could legally do it. I will argue that with anybody. I strongly believe that if people took the time to educate themselves on these topics, that they would take advantage of it. And I'm probably going to write a book or, you know, some type of guide on how you can take advantage of these things. I'll probably do a small 50-page guide that can teach people how to knock down their taxable income. So I really wanted to really go live on this today because I felt like this was a really important topic for us to discuss. I'm probably going to post a lot more content regarding this topic to give people some insight on how a lot of this can work. So again, educate yourself, research. I'm going to be posting a lot on my channel. Make sure you go through a lot of my old videos where I talk about a lot of these things. Don't be afraid to reach out and ask questions, watch some videos, leave comments. If you need to schedule a consultation, I'll be there to help anybody out. I'm always available. So again, thank you for everybody that's tuned in today to watch this video. I appreciate y'all and hope y'all stay blessed.